Apple up 78% on the year. If we look at Amazon, Amazon is currently up 68% on the year. If we look at Microsoft, Microsoft up 42% on the year. If we look at Google, Google is currently up 27% on the year. Facebook currently up 36% on the year. All of these tech stocks are at sky-high valuations, and then it leads me to this article. A wealth manager says now is the worst time ever to invest in, quote, crazy expensive growth stocks. And so in this video, I wanted to go over this article and I wanted to show you multiple charts. I wanted to show you this with the value versus growth differential. I wanted to show you the average price to book ratio comparing value to growth stocks. I wanted to show you this chart. I screenshotted this chart without telling you what stock it is, and I wanted to show you my opinion of investing in a growth company versus a dividend company. And then I wanted to show you the price to book growth versus value valuations that are into the stratosphere. And then I got this idea from a comment, and this is how I decided to make this video. So shout out to Angel. I love when people write in-depth comments like this. It really gives me great video topics and video ideas. So he says, "Hey Jordan, I've been following your channel for a few weeks, and I'm getting little by little changing my investing strategy from growth to dividend. I have to admit I lost some hard-earned dollars following growth, so lesson learned. But I was wondering if your M1 Finance portfolio shows all of your investments, or if you have in effect some growth positions that you do not disclose. Just wondering, as you're the only YouTube investor that I see that is true to a dividend strategy. And I have a second question. What is your opinion on tech value stocks?" He said Valley. I'm sure he meant to say value stocks. But value companies such as Cisco, Intel, and Qualcomm. Some of them have a huge cash pocket and still have some space to turn things around over the next few years. Your opinion on these companies with a long-term horizon. Thank you so much for your response. Well, thank you so much, Angel, for writing in. And I wanted to go ahead and start off with your first question. Do I have any other investments outside of this dividend portfolio? And the answer is no, I do not. As you can probably tell if you've been following me for a while, I like to disclose everything. One of the reasons why I disclose my YouTube income is because no one else does it. It is fully transparent. I showed everything. The reason why I show all the stocks that I own, every single video, I showed every single stock. So if there's ever a change, you guys can see it immediately. My activity feed, you guys can see everything that I do, from buys, sells, dividends, referral bonuses, anything you could possibly imagine, you guys get to see it all. Literally, the example that I always give is that the only difference between me seeing this and you guys seeing this is that I have a login to my account and you guys don't. But no, I do not have any other investments outside of my dividend portfolio because I am true to the strategy, and this is why I preach it. There are other strategies that I have considered and other things that I might end up doing later on in the future, but if I do, it will all be documented on this channel. And then your second question, what is my opinion on the tech value companies such as Cisco, Intel, Qualcomm? Well, I'll go ahead and bring that in later into the video. But speaking of Qualcomm, I just mentioned in my previous video, literally yesterday, that I thought in the next 2 or 3 years, Qualcomm will be up to $200+ a share. And if there's ever a time to show that, today it's up $17 a share from about 130 up to 146. That's up 13.5%. They just came out with a huge earnings beat, and this stock, who knows, maybe before the end of 2020 could even hit that $200 mark. But Qualcomm is a company that I own, and I've really done good with that investment. But before we jump into all of these charts and before we start looking into those articles about these growth companies, let's go ahead and mention that if you're not signed up yet, please use this referral link to get signed up with M1 Finance. If you sign up and deposit $100 to the platform, you get $10 just for signing up. We've had 53 people. Another one this morning just signed up. 53 people have signed up. Go ahead and get that number to 54. And speaking of my dividend portfolio, if you want to see all the holdings that I have, this link is in the description as well as a lot of other things as well. So thank you guys for checking that out. And let's go ahead and jump into this. A wealth manager said it's now the worst time to ever invest in crazy expensive growth stocks. Now I wanted to look at a couple of these charts. I wanted to compare this to the dot-com bubble. This is the value versus growth differential. You can see the 1929 Great Depression right here, the Wall Street crash in the early 30s, and then we get to the Nifty 50 bubble, and then the 1970s. Then you go to the dot-com bubble, and that's the one that I really want to focus on because a lot of this growth has been driven by a lot of tech companies. The dot-com bubble had a -2 standard deviation from the normal stock market levels. Now, if we go to today, it is the worst it's ever been. And you see this little graph says, do you see what we see? And then let's go to the next chart. Let's look at this one. This is the aggregate price to book ratio. So this is value, growth, value average, and growth average. You can see the growth is so much higher on a price to book ratio than that of what a typical company like a value company has. And let's go ahead and go further. Let's go ahead and look at this chart right here. On price to book, growth versus value valuations are in the stratosphere. And you can see times where it goes up, goes down. And let's go to the dot-com bubble. You can see it got to about a 4 here in 2000 when things got to sky-high valuations. Well, let's go ahead and fast forward to 2020. At 2020, this is currently about a 5, 5.5. That is a massive standard deviation between these growth companies versus these value companies. So what I wanted to do is I went ahead and I went and took a specific time period of a company that you all know. It is a great high growth tech stock, and I went ahead and captured part of this stock chart. And this little high up moment right here, this little bump up in the stock chart, when it got to about $60 a share, this was in 2000. So before I tell you what this company is, if you would have invested in this company in the year 2000, you would have not seen a positive return on your investment for about 16 years. 16 years. I want to repeat that again. You would not have a positive return on your investment for 16 years. So this is why I think people should focus a little bit more on dividend investing rather than focus on things like growth and high-tech stocks. Now let's go ahead and look at this current chart today. While this company might have had a horrible looking stock chart for the next 10 years, let's look at today. The company that this was is Microsoft. If you just look from 2000 all the way until the early 2010s, this company pretty much went nowhere. And even a lot of this time, they paid no dividends. So if you're just looking at stock prices, it's easy to say that, oh, this company has incredible performance. But if you're buying this company at sky-high valuation, if you're buying, say, here at the peak of the dot-com bubble, you only have about a 280% return over the course of 21 years. Over the course of 21 years, a 280% return is not that great. So this company is a great company. I love it. I'm not saying we're in a tech bubble. I'm not saying we're at the peak, but it's just something to keep in mind. Now, I wanted to show this article here. I think that this article pretty much wraps it up a lot better than what a lot of these other articles can. It talks about dividend investing. Some of the advantage of dividend stocks are that they tend to outperform growth stocks, offer consistent cash flow at regular intervals, and because stocks that offer dividends typically indicate that a company is financially healthy enough to pay shareholders cash, the investment can be less risky. Having an obligation to pay out dividends typically forces management to make disciplined decisions about capital allocation. Now, I wanted to show these last two lines. The investment can be less risky, and they have to be more disciplined about capital allocations. A lot of these tech companies, a lot of these high growth companies are investing at incredibly high levels back into their business. And that is what is making them grow at incredibly high rates. A lot of their investments are growing just as fast as their stock prices are. And this has created some incredible stock prices that have never been seen before. For example, Nvidia is a company that I've always been a fan of. I never invested in them, but I remember looking at this company back when they were under $200 a share and thinking, wow, this company's at a pretty good price right now, back in 2018 when the whole China situation happened. Well, if you look at today, it's over $1,000 a share. Now, with these companies reinvesting back into themselves, when you look at a lot more boring investments, a lot more old school investments, when you look at things like Coca-Cola, Coca-Cola doesn't have nearly as impressive of a stock chart, but it has steady dividend payments going up every single year and not nearly as much volatility. If you're investing even at the peak, you're not getting nearly as much as the downside as a lot of these other companies are. And the same thing for a lot of other stable companies as well, such as like Procter & Gamble, companies that I own like that, and they're still steady returns up and up and away. But we go back to this article, but the investment is typically less risky. These companies, while they might not have as good as performance, they are not nearly as risky. And I know that no matter what I buy these stock prices at, I know that I'm going to get a positive return. If I'm investing in a company like Nvidia at $500 a share, $600 a share, at sky-high valuations, if they don't come up with incredible numbers, I'm going to have a negative return. The stock could easily go back down to $400, $300, $250 a share, and then I'm out in the cold. But as I've mentioned many times, what I look forward most to in my portfolio is my dividends. I focus on the company as a whole and where their dividend yield, their dividend growth is going. So, for example, I'll go back to Qualcomm here. Qualcomm makes up 2% of my portfolio, and after today is one of my best performers. Qualcomm, I am up quite a bit on 129% on a money-weighted return. If we go to the stock chart here, it is doing quite nice, up 12% today. I think earlier, what was it, up like 14%? And this last 5 years have been great for Qualcomm. Now, when I started buying this company, let's go to my activity feed here. Let's go to my first activity. When I first started buying Qualcomm, I bought it for $67 a share. $67 a share is when I decided to make the decision to invest in this company. So $67 a share is what I started at, but today it's at $145. I'm still buying this company, but I'm not going to increase my position in it. If it gets to the 200s, I might even take profits and then reinvest that elsewhere. Now, when I was buying this company at $67 a share, I was buying this at almost a 4% dividend yield. Well, today it's under 2%. It's like 1.8 after today's move up. So this is not nearly the type of dividend company that it used to be. Now, in my scenario, I do have a lot of profits. If I want to sell this company, I can just sell this company, take the profits, and reinvest that back into other companies. Just off the market gains, I have about $60 worth of gains. I can take that $60 worth of profit and buy any one of these other stocks on these lists that have been hit hard and not have nearly the amount of upwards movement that Qualcomm has. But to go back to YouTube and answer your question, talking about Qualcomm, I still think that there's tons of upside opportunity from a dividend growth perspective and a growth perspective for the share price. I think that Qualcomm has a long way to go. Cisco and Intel, I think it's kind of a toss-up. I could see a scenario where they come back and they get some capital preservation and find ways to grow their company. But honestly, I'm not too impressed. There's a reason why I don't invest in either of them. While they have great yields, I don't exactly like the direction that either of the companies are moving. And I just flat out, I'm just not as confident in these companies as I am a lot of my other investments. So that is why I do not own them, especially Cisco. Big question mark there. But thank you so much for writing in. And thank you so much, guys. You made it all the way to the end. I really appreciate it. If you want to support me, if you want to follow along with me in the channel, if you want to watch me update these charts every single month, my annual dividend income, monthly dividend income, portfolio, and monthly YouTube income, please subscribe. I would invite you to do so. And like I said in the beginning of the video, if you haven't checked this out already, my portfolio is shared in the description as well as other things as well, like Yada savings accounts, portfolio reviews, credit card referrals, other things like that. And if you want to get signed up with M1 Finance, you deposit $100 to the platform and get $10 just for signing up. So thank you guys so much, and I'll speak to you guys next time.